If I lost everything today and only had $1,000 in America in 2026, this is exactly how I'd invest it. No hype. No gambling. No get-rich-quick nonsense. Because let's be honest, most people hear $1,000 and think, is that even worth investing? Or worse, what if I put it in and the market crashes tomorrow? And I get it. Inflation is still eating paychecks. AI is changing jobs. The market feels unpredictable. So the fear is real. But here's the truth nobody tells you. It's not the amount of money that builds wealth. It's how you deploy it and how early you start. I've seen people waste thousands chasing hot stocks and crypto hype. And I've seen regular Americans turn a small, boring $1,000 into life-changing money by following a simple system. In this video, I'm going to show you exactly what I would do, step by step, if $1,000 was all I had. No complex charts, no Wall Street jargon. By the end of this video, you'll have a clear, realistic plan you can actually follow starting today. Let's get into it. The biggest mistake people make with their first $1,000 is trying to turn it into $1 million overnight. They chase meme stocks they don't understand. They jump into crypto pumps after the price already exploded. They follow gurus promising fast money with zero risk. And most of the time, that $1,000 disappears. Here's the hard truth. When you're starting small, losing money hurts more than missing gains. Because once that capital is gone, your momentum is gone too. At this level, your number one job is capital protection, not hitting home runs. You don't need a miracle trade. You need a survivable strategy. Think of your first $1,000 like a seed. If you gamble it, you might get lucky, or you might kill it. But if you protect it, nurture it, and grow it slowly, it compounds into something real. This is the mindset shift most people never make. Your first $1,000 is not meant to make you rich. It's meant to teach you discipline, build confidence, and create momentum. Once you understand that, everything changes. Before I invest a single dollar of that $1,000, I do something most people skip by and set the foundation. First, a quick reality check. If you're carrying high-interest credit card debt, 18, 22, even 29% investing comes second. No stock consistently beats that kind of guaranteed loss. Second, I'd build a small emergency buffer. Not 6 months. Not some perfect number. Just $300 to $500 in cash. Why does this matter so much? Because investing without a safety net turns normal market dips into emotional disasters. The moment your car needs repairs, or a medical bill shows up, you're forced to sell your investments at the worst possible time. That's how people panic sell. That's how they lock in losses. Not because the strategy was bad, but because the foundation was weak. Here's the lesson most investors learn too late. Discipline beats returns in the early stages. Anyone can look smart in a bull market, but the people who actually build wealth are the ones who stay invested when things get uncomfortable. So before chasing growth, protect your ability to stay calm. That's the real first investment. Once the foundation is set, here's exactly where I'd put the first $500, a low-cost S&P 500 or total market ETF. Why ETFs? Because in 2026, they're still the simplest, most powerful way to grow your money without taking unnecessary risks. They give you instant diversification. You're not betting on one stock, one sector, or one hype trend. And with low fees, more of your money actually stays invested instead of going to Wall Street. Here's the beauty. The S&P 500 has a proven track record of long-term growth. It won't make you rich overnight, but over time, your money grows exponentially thanks to compounding. Think about it. If your $500 grows just 8% a year, in 10 years, it's nearly $1,100. And that's without touching it. 20 years, over $1,500. It's slow but steady and predictable. This $500 isn't flashy. It's not a gamble. It's your financial backbone, the part of your portfolio you can count on to grow, even in uncertain markets. The key is consistency, not heroics. Start here, stay disciplined, and everything else you add on top becomes easier and more powerful. Next, I take $300 and put it into dividend or cash flow-focused ETFs. Why? Because this is where your money starts working for you even while you sleep. Dividend ETFs provide stability compared to volatile growth stocks, and they teach you a passive income mindset from day one. For beginners, dividends are more than just a payout, they're psychological anchors. Every quarter, when a small amount hits your account, it reinforces the habit of investing. It proves that your money can grow predictably, even if the market wobbles. Think of it like planting a money tree that gives you fruit regularly. Even if the stock price fluctuates, you're still earning along the way. The key here is patience. Don't cash out when prices dip. Reinvest those dividends. Let compounding work its magic. This $300 isn't about hitting a home run. It's about building a foundation for long-term financial confidence. It's teaching you to hold, grow, and let your investments support you, not stress you out. By combining the first $500 in broad ETFs with this $300 in dividend payers, you're starting to build a balanced, resilient portfolio that works for the long haul. Finally, let's talk about the last $200, the part where you can take a little controlled risk. I'm not talking about gambling, chasing memes, or day trading. This is calculated growth exposure. Think a ETF, or a fund focused on AI and innovation, the industry's driving 2026's biggest opportunities. The key here is position sizing. You're only risking $200. That's 20% of your $1,000, not your life savings. This ensures you can sleep at night, even if the sector dips 20% tomorrow. Here's the mindset. This $200 is for learning, growth, and opportunity, not desperation. If it doubles, great. If it dips, it's small enough that it doesn't derail your strategy or your confidence. This approach teaches discipline while giving you exposure to high-potential trends. It balances your portfolio. $500 in broad market ETFs, $300 in dividends, and $200 in controlled growth. By the end of this, you've created a small but powerful portfolio, stable, income generating, and just enough growth to keep things exciting. It's smart risk, done the right way without gambling or losing sleep over it. Once that first $1,000 is invested, the real power comes from what you do next every month, even if it's just $50 or $100. Putting money in consistently is more powerful than trying to time the market. This is called dollar cost averaging. Every month, you buy shares at whatever price the market is, sometimes high, sometimes low. Over time, it smooths out the bumps and reduces risk. Here's the magic. Small, consistent habits beat big one-time moves. You don't need to hit a home run today. You just need to show up month after month, adding to your $500 in ETFs, your $300 in dividend funds, and your $200 growth position. Even $50 a month, compounded over 10 or 20 years, turns into serious wealth. It's predictable, it's reliable, and psychologically, it builds confidence and momentum. Think of it as turning your investment plan into a habit, not a sprint. The first $1,000 is just the starting line. The real race is in consistent, disciplined contributions that turn small wins into life-changing results. Before we wrap up, let's talk about what I would never touch in 2026 with my first $1,000. No day trading, no options, and absolutely no hot tips from social media. I know the temptation is real. Everyone loves the idea of turning a few $100s into thousands overnight. But here's the truth. For beginners, these strategies are financial landmines. Day trading isn't investing, it's gambling. Options are complex, high risk, and can wipe out your portfolio in minutes. And social media tips. Most of the time, the people posting them don't have your best interest in mind. Chasing these paths destroys more than your money. It destroys confidence, discipline, and peace of mind. You start second-guessing every move, panicking at every dip, and losing the momentum you worked so hard to build. If you want to grow wealth in 2026, avoid the shortcuts. Focus on protecting your capital, growing steadily, and letting compounding work for you. Remember, the goal is not excitement, it's financial progress that sticks. Your first $1,000 is too precious to risk on anything that feels like gambling. Let's end with a reality check, because if you're expecting to get rich in 12 months with $1,000, you're in for disappointment. Here's what's realistic. After a year of disciplined investing, consistent contributions, and smart risk management, you won't be a millionaire, but you will be financially confident. You'll understand how markets move, how compounding works, and how to make your money work for you instead of the other way around. This first year is about skill building, not instant wealth. It's about learning the language of finance, spotting good opportunities, and developing the discipline to stay invested even when things get shaky. Every $50 or $100 you add each month isn't just building your portfolio, it's building habits that last a lifetime. Think of it as planting a tree. The first year, you won't see the forest, but the roots are growing, and those roots will support exponential growth in the years ahead. So stay patient, stick to the plan, and celebrate small wins. By the end of 12 months, you won't just have more money, you'll have the confidence and skills to make it grow even faster. This is how $1,000 becomes the start of real financial momentum. Here's the bottom line. Your first $1,000 can change your financial life if you treat it with respect. It's not just money, it's your foundation, your practice field, your confidence booster. How you handle this $1,000 sets the tone for every dollar you'll invest in the future. And if you're thinking, I'm late, I've already missed my chance, stop right there. It doesn't matter how old you are or how small your starting point feels. Every millionaire started somewhere, and for many, it was far less than $1,000. The key is consistency, patience, and step-by-step growth. Wealth is not built in a single trade, a single tip, or a single lucky break. It's built slowly, intentionally, and with discipline. So take action today. Protect your capital. Invest smartly. Build habits. Even small, consistent steps move you closer to financial freedom than waiting for the perfect moment. Treat your first $1,000 with respect. Stick to a plan and watch how it snowballs. Because the truth is simple, step by step, dollar by dollar, momentum turns small beginnings into life-changing results. If this video gave you clarity on how to invest your first $1,000, go ahead and hit that like button. It really helps us reach more people. For practical, no hype finance strategies every week, subscribe to Finance Flash. And I want to hear from you. Comment below. What would you invest your first $1,000 in? Let's get the conversation started.